If you are interested in learning some of the ins and the outs, the good and the bad, the yin and the yang, the pros and the cons about FHA financing, then you are in the right place. Matt, the Efficient Finance Guy here. Today, I'm going to share with you my top three pros and cons in regard to FHA financing. Now, I've been in the residential mortgage lending space for 1 month shy of 29 years. So while everybody has an opinion, and everybody is entitled to their opinion, I'm going to give you my thoughts on my top three good and my top three bad. So let's dive right in. So, as it pertains to FHA financing, my number one pro, and stay tuned because number three on the cons might surprise you, and it's likely not going to be what you might think. So here we go. Number one, it is the debt ratio tolerance or flexibility that FHA offers, which is greater than a standard conventional Fannie Mae or Freddie Mac loan. So, in a nutshell, what that simply means is we as lenders, when analyzing what is the buying power or spending ability of a potential client, one of the driving factors that we look at is what your overall debt ratio is. So, to summarize that very quickly for you, let's just say, for the sake of simple numbers here, a client has $10,000 per month of income that is allowable and usable on their loan application. Well, when we look at a debt ratio, what we're taking into account is the total all-inclusive payment for the home that they're looking to purchase. So principal, interest, taxes, insurance, flood insurance, if that's applicable, mortgage insurance, as well as any homeowner association dues if they are purchasing a home in a community that has additional fees associated with owning the home. So in the sake of an example here, let's just say someone is looking to purchase a home and the monthly payment is going to be $3,000. Well, with $10,000 a month of income, then the housing ratio, so simply the house as a percentage of the monthly income that client is bringing into the equation, would be 30%. So $3,000 against $10,000. But the debt ratio is the one where things get a little trickier in terms of limitations on what you as the consumer can qualify to borrow. So if you have a proposed monthly payment of $3,000 and your other life expenses are $2,100, so let's call that two car payments, maybe a boat loan, maybe some student loans, maybe some other credit cards, whatever those other credit related borrowed money obligations are, because generally speaking, utilities, so cell phones, internet bills, medical insurance coming out of your paycheck, auto insurance, those things do not impact the debt ratio in most cases. So with that being said, if your other expenses were $2,100 and the housing payment was $3,000, you would be looking at $5,100 a month or a 51% debt ratio in relation to your $10,000 a month of income. Well, if you were applying for a standard conventional Fannie Mae or Freddie Mac loan, that loan would not be eligible to achieve an approval because the debt ratio exceeds 49.99%. So with FHA, a 51% debt ratio may very well be approvable all day long, and it could go as high as 55, 56, maybe even pushing 57%. So in this current day and age, where income is sometimes a little bit questionable for some folks, there are some people that might be working 2 or 3 jobs, and in some instances, the second or the third job's income may not be allowable given the history and the backstory on that or the time that they've been doing those second or third jobs. So sometimes when you're dealing with analyzing numbers for a client, and looking at, car prices are higher than ever, credit card interest rates in light of where we are at this moment in time in the fall of 25 are higher than they've been in many, many years. So when you're looking at someone's income and then looking at their other debt obligations, the flexibility that FHA affords a potential home buyer by giving that extra leeway on where their debt ratio can be could be the difference between achieving an approval or not when it comes to pursuing your financing. That is going to lead me to pro number 2 when it comes to FHA financing. And that is very simply that a client's credit score has minimal, if any, impact to the interest rate that they may receive on an FHA loan, and it has no impact to the monthly mortgage insurance that is going to be a part of that monthly payment. Now, when you compare that to a standard conventional loan, first, conventional loans are going to be hypersensitive to a client's credit score. So there are little 20-point increments and windows in what that specific pricing is going to look like for you as a consumer, depending on exactly where the credit score falls in a pretty wide spectrum. So going down to the low end of 620 all the way up to 740 to 760, you're going to be looking at pricing differences as far as the cost or the interest rate itself on conventional financing based on where exactly your credit score falls within that range. On an FHA loan, and I can't speak on behalf of every investor and every lender and every bank out there, but generally speaking here, if your credit score is 640 or 740, you are likely not going to see that there is any pricing variance for an FHA loan, either to the interest rate or to any points or fees or costs associated with that interest rate. Now, I have seen over the years in some instances where if I were to compare, let's say, a 625 credit score to a 745 credit score, there might have been a nominal eighth of a point variance on the points or the fees factor. But generally speaking, the interest rate itself is going to be the same regardless of where the credit score falls. And as far as the monthly mortgage insurance with FHA, that is just a standard fixed calculation. So I don't want to get into the details of how that works, but for the simplicity of giving you an example, on an FHA loan right now, as of the time of recording, if you were borrowing $100,000, if you were to take that times 0.0055, you're going to come up with $550. You would divide that by 12, and that would be the cost of your monthly mortgage insurance for that first year in your new home. Now, if you compare what that could look like on a conventional loan, if you are dealing with someone that is putting 5 or 10% down and they have a very strong credit score, that monthly mortgage insurance factor or that percentage driven expense tied to the mortgage insurance, it could be a little bit lower and likely would be a little bit lower than what it would be on FHA. But on the flip side of that, if you have a client coming into a transaction and let's say they're looking to do 3% down on a conventional loan and their credit score is 635, their monthly mortgage insurance factor on a conventional loan could possibly be 3 to 4 times higher than what that cost would be on an FHA loan. So for that same $100,000, instead of 550 divided by 12 to come up with your monthly amount, you could be looking at, let's say, upwards of maybe $2,000 annually divided by 12. So that could be up in the 150, 160, maybe 170 a month range. And that is per $100,000. So if you're looking at a $300,000 or a $400,000 home, you can see how that could get very expensive depending on what your personal circumstances are that influence those cost factors. That is going to lead me to item number 3 on the favorable side of an FHA loan. And that is very simply that FHA allows a larger amount of money to be contributed toward your transactional expenses at the time of closing from the seller of the property if that has been negotiated into the details of your contract. So in the world of FHA, you can get up to 6% of the sales price from the seller that can be applied towards your closing costs and or your prepaid items associated with your closing. And just for quick clarity here, closing costs are one-time non-recurring expenses associated with buying the property and going through the process of securing a mortgage and closing on that property. So things like lender related fees, appraisals, surveys, title company charges for settlement, any local, state, or county documentary stamps or intangible taxes. Those are paid one time at the time that you go to closing. Those are technically closing costs. And then prepaid items are things that are an expense that are associated with owning the home, and they are more of an ongoing or recurring type of an item. So the premium for the homeowner's insurance for your first year in that home, that is a prepaid expense. You're prepaying to purchase insurance coverage for the next 12 months. The establishment of your escrow account for your taxes and insurance and flood insurance, if that's applicable. Those are prepaid items. You're prepaying into something for expenses that are going to be recurring and ongoing as a result of you owning that property. So between any points that may apply or fees associated with the interest rate that you choose, closing costs, and again, prepaid items, with a 3.5% down payment being satisfied on an FHA loan, you can get up to 6% back from the seller. Now, in many instances, 6% is not going to be needed, but you can get up to that much. Now, here where I work and live in the Southwest Florida area, you're typically going to see overall transactional expenses, so closing costs and prepaids, coming in above 3%, but not as much as 6%. And it just depends on the details of the transaction. In other markets, I know closing costs may be a little less expensive, and then there are some areas throughout the country where overall expenses may be a little bit higher than what I am used to dealing with here. But if you were to compare that to a conventional loan, and someone was going into the transaction with 3% down or 5% down, they would be limited and only able to obtain up to 3% of the sales price back from the seller at the time of closing, if that had been negotiated into the terms of the contract. So when you consider the fact that oftentimes FHA loans are utilized by entry-level buyers or first-time home buyers, there's often a shortage of, let's say, assets available, especially if they're a younger buyer and they've been saving. Maybe they have a little bit of money in the bank and they're just trying to be able to buy their first home and get to the closing table. Oftentimes you will see contracts come in where there is a credit negotiated in there for the seller to cover the bulk of those expenses, because that is a dollar for dollar savings to the client, in the sense that if there is a $3,000 credit from the seller toward closing costs in the transaction, that is $3,000 that does not need to leave the buyer's bank account. So prices can be negotiated down, but when you factor in there's still going to be a down payment requirement against the remaining or the new reduced sales price, and then you factor in what the closing costs are, it can lead to essentially almost double, or if not a little more, what the client is thinking they may need. So what I mean by that is, if you're buying a $100,000 home and FHA requires a 3.5% down payment, well, that's $3,500. But if you don't have any credits from the seller helping you with that transaction, then when you factor in prepaids and closing costs, you might still need $7,000 or $8,000 or $9,000 to be able to successfully close that transaction. So while the down payment itself is only $3,500, there is all that rest of the story in terms of expenses that come along with purchasing the home. So in many instances, having that little bit of extra wiggle room or threshold of being able to negotiate 4 or 5% of the sales price from the seller as a credit to you as the buyer can, in many instances, make or break whether or not that transaction could successfully get to the closing table. So with that being said, those are my top 3 good items as far as FHA financing. We are now going to jump into my cons or my negatives regarding FHA. So number one, monthly mortgage insurance is unavoidable on an FHA loan. So regardless of what your down payment level is, monthly mortgage insurance is going to be a part of your monthly payment, at least for some period of time. Now, to clarify what that means, if you are utilizing an FHA loan and you are putting down less than 10%, the mortgage insurance will be present in your monthly payment, and it will be there for as long as you have that mortgage in place. So it is not forgivable. It is not cancelable. It doesn't just automatically go away or drop off of your monthly payment at any point down the road. Now, if you're utilizing an FHA loan and you're starting with a down payment of 10% or more, you will still have mortgage insurance, but it will eventually drop out of your payment somewhere typically around the 11-year mark based on the numbers and the details within that product line. So while lifetime mortgage insurance sounds unfavorable, and I'm not saying that it's necessarily a positive thing to talk about, but one thing to keep in mind is that every year the loan balance gets analyzed against that mortgage insurance factor of 0.0055. So you do need to realize that each year, as your loan balance comes down and that factor gets recalculated against your outstanding loan balance, your monthly mortgage insurance does get a little less expensive and a little less expensive. Now, this is not anything that typically you're going to look at and go, wow, that's a tremendous savings year over year, just based on how a normal amortization schedule runs. But the point of the matter is, if you bought that home, you never refinanced, you never moved, and you stayed there for a full 30 years, when you get into the latter years of that loan, you are going to continue to see that that mortgage insurance is getting less and less expensive. And down in those last couple of years, it's going to be almost nothing, but it is there for the life of the loan. And again, if you were to start off with a 10% down payment or more, it would eventually drop out of the equation. And that is different in terms of that lifetime component than when you're looking at a standard conventional Fannie Mae or Freddie Mac loan, wherein at some point along the way, without getting into all the details on that, so let's just say guaranteed automatic by law and regulation, when you hit 78% in terms of the loan balance relative to the price that you paid for the home, your PMI or monthly, private mortgage insurance on a monthly basis would fall out of your payment. There are a couple other variables there, but this is about FHA, not conventional. So that's going to lead me to con number 2 on FHA loans. And that is very simply that there is an upfront fee that applies to every FHA mortgage that comes into existence. It is known as an upfront mortgage insurance premium. So in the spirit of explaining kind of what the perspective and the view coming out of HUD and FHA would be, instead of them having that monthly component be a variable item that is based on credit score or details on the transaction or risk analysis on a transaction, whereas on that conventional side with that private mortgage insurance, based on your credit score, the amount you're putting down, that number can vary widely. FHA has it as a standardized fixed number for the monthly component, but because they have that as a very attractive number, they also collect a chunk up front. So it's more of a blended element here. So you do have the monthly mortgage insurance, but you also have this upfront mortgage insurance. So what does that really mean and what does that look like? Well, let's just say again, you put your down payment down and you are looking to borrow $100,000. Well, what FHA does is they take the loan amount after your down payment is applied to the sales price and they multiply that times 1.75%. So if you were looking to borrow $100,000 after your down payment was applied, your final and total end loan amount on that new loan would actually be $101,750, because that 1.75% is typically financed onto the actual loan. Now, you certainly can pay that as an out of pocket expense. But again, when you look at generally and broadly here, the scenario of many people that take advantage of FHA financing, money in the bank and excess assets are not typically going to be what you see as part of the overall analysis. So FHA allows that to simply be added onto the mortgage amount and not required to be paid as an out of pocket expense. But again, you certainly could do that. But in thinking about this, since it is a negative or a con that they collect this charge, when you consider the fact that your down payment is 3.5%, and then 1.75% gets collected by HUD and added back into the loan, it is essentially cutting your down payment in half in terms of how much you are borrowing relative to the price that you are paying. So with that being said, I'm going to move on to number 3. And this is the one that, after the amount of time that I've spent in the industry, it rubs me the wrong way, and it does personally bother me. And that is simply the perception out there about FHA financing. And I'm saying this in the capacity of the person and possibly the real estate agent representing the current owner of the home. So the seller and or maybe their real estate agent, when they see an offer come in on their property, if the borrower has indicated on that offer that they are pursuing FHA financing, there is oftentimes going to be a case of a little bit of anxiety, a little bit of trepidation, or a little bit of hesitation about whether or not they want to accept that offer, out of fear of whether the borrower is qualified enough or whether the loan is actually going to go through. Is this going to be a successful closing, or should we limit the offers that we accept to either cash or standard conventional financing? And here's the reality of that. If you are pursuing FHA financing and you are talking about a standard resale home out there in the market, and it is habitable and livable, and everything in that home is functional and in working order, in most instances, there should be nothing that causes any level of alarm for a potential seller or the agent representing that seller. Now, in some instances, yes, FHA is going to be utilized because the credit profile or the debt ratio or some other element pertaining to the borrower, maybe it is a little bit on the weaker side. So there could be truth there. But it just seems like there's this broader misconception. I had a client many, many years ago, this going back to the early 2000s, very well qualified, money in the bank, excellent credit score, excellent job stability. He was self-employed, had his own business for like 15 or 20 years. Income on paper was wonderful. So there were no problems in terms of this borrower qualifying to get the money to purchase the home. But in conversations while we were leading up to him actually securing a contract for the property, we had just discussed the fact that, well, if you switch this from a 10% down conventional loan to a 3.5% down FHA loan, when you looked at how all the numbers played out, it ended up being that the monthly payment was $50 to $100 a month more on the FHA scenario than it was on the conventional. But it allowed him to hold on to like $25,000 to $30,000 in down payment funds that wouldn't be needed if he went FHA. And he had a desire, as soon as he closed and moved in to the home that he ended up choosing, he wanted to do some upgrades to the home, install some solar panels, and that extra $25,000 to $30,000 was going to allow him to do that without needing to finance that elsewhere on a credit card or through private financing or whatever. So we ran into some challenges trying to get his offer accepted, because at that time in this local market, it was a bit of a higher priced home. And the seller and the real estate agent on that side of it, they were just concerned. They didn't want to do an FHA loan, thinking there was going to be problems. There is, in most instances, there's no little inspector from HUD that comes out to look at the home. There are a couple of items that when an appraisal is done, an appraiser needs to pay a little more attention to than if they were doing a conventional loan appraisal. So, if there's a cracked window in the home, or if a window doesn't lock, or a window doesn't stay up when you push it up and it just drops closed because the springs are bad, or if there's a door in the garage and the lock doesn't work and you can't open that door, if there's a couple steps outside and they don't have a railing, those are all health and safety items that under an FHA scenario would need to be addressed before you could get to closing in most instances, or maybe addressed shortly after closing. Whereas on a conventional loan, minor little things like that would likely not come into play. But aside from that, an appraiser doing an appraisal for an FHA transaction may very well be the same individual person that would have been doing that appraisal for a conventional loan. It's just that they have gone through the training, the certification, and they're authorized to do an appraisal on behalf of FHA. So there's a little bit of a variance there. But the days of 20 or 25 years ago where, FHA would oftentimes call for all these supplemental inspections, whether it was on the roof or on the air conditioning unit or on a septic drain field, most of that doesn't apply anymore. So there's really no reason for the seller side of a transaction that is looking at an incoming offer to really have an elevated level of concern about accepting that offer, unless there are issues with that home that could prevent that transaction from closing seamlessly without the possibility of maybe a couple of minor repairs or upgrades. So everything in the world of real estate is always a little more complicated than what we can convey in a quick message here. But the fact that oftentimes you will see someone presenting an FHA offer on a property and it's getting rejected, there may be open communication that the seller doesn't want to accept an FHA offer, or it may be kind of inferred that that's the case. I find it frustrating. So that is where working with a quality professional real estate agent and a lender in conjunction with each other to properly structure your offer and have open and effective communication with the parties on the other side of the transaction for a home that you're looking to purchase becomes critically important. Thanks for watching. Matt, the Efficient Finance Guy here. If you or anyone you know has any questions about anything pertaining to FHA loans or home loan financing, or you maybe have a need anywhere in the state of Florida, please don't hesitate to reach out. I'd be more than happy to help or answer your questions in any way that I can. I'll look forward to seeing you in the next video. I hope you found this helpful. Go ahead, like this, subscribe if you want to see future videos when they're dropped. And if there's anyone in your circles that may benefit from this information, go ahead and share this video with them. Thanks for tuning in. I look forward to seeing you in the future. Well, hey there, if you are still with me, thanks for sharing a little time with me today. I hope you found this video helpful and informative at any point, and whether that is 2 weeks, 2 months, or 2 years from now. If you have any questions about financing or mortgages for any type of property located anywhere within the state of Florida, please feel free to reach out. I'd be more than happy to have an initial consultation with you, learn a little bit about what your needs, wants, and desires are, and see if we can come up with a loan program custom suited to take care of your situation. If you are self-employed, we have solutions in the market today that can help you with that as well. If you have ran into financing issues due to self-employment in the past, and if you are seeking standard, traditional, regular financing, we do all those loan programs really well as well. I would be more than happy to consult with you and put my team to work for you. Make it a great day. Thanks for watching, and I'll look forward to hearing from you if there's anything you'd like to discuss. This is Matt, the Efficient Finance Guy, proudly representing Main Street Home Loans, NMLS ID 296861, and we'll see you again in the next video.